Hey everybody, Steve Olson with the Peak Group and the Investors Corner podcast, and I'm excited to have a longtime colleague, friend, business partner, in many cases, really just been my attorney for a long time. Um, and so, yeah, they end up kind of being all those things at some point along the way, and it's been cool to see him on his journey. I've got Mat Sorensen with Directed IRA and also KKOS Lawyers here. Matt literally wrote the book on self-directed IRA investing. I think, Matt, was it your very first property you ever did in your IRA that I helped you with? Was that the first one?
Exactly. Yeah. Yeah. Steve sold me my first property that I bought with my own retirement account
Yeah.
because I was helping clients for all these years, buying real estate in their own retirement accounts, their IRAs. And I was like, I got to do this for myself. Then I remember
Yeah.
Steve was like doing deals in Indiana himself. And I'm like, well, if a guy who sells real estate is buying real estate himself, it must be good. So can you get me one of those? And
Yeah.
I did great on that property. I don't know if you ever heard, but like I bought it from you at 85 in 2017, rented at 950 a month. Um, and by the time I sold it, I was at 1250 a month in rent. This is 5 years later. And I sold it for 185 grand. I mean, that was a great window, right?
That was a,
2017 to
yeah.
2020, what was that? 2023, I think, 2022. Anyways,
Yeah.
yeah,
You had the wind at your back. And,
that's right.
but I think it illustrates the point. If you stay in the market long enough and you do a deal that's sustainable, you will get the wind at your back at some point.
Yeah.
And
And if you
yeah.
buy some that can cash flow and you're willing to wait the right time, real estate's cyclical, whether people like it or not. But when the timing's right, that's when you sell and you can take your chips off the table. But when it cash flows, and as my case it's putting money back in my retirement account and helping cover the expenses. And then my retirement account got the benefit of the appreciation, sold it, no tax, went back to my retirement account.
Yeah.
Pretty cool deal.
Yeah, that's awesome. Got to use it and, eat your own cooking, so to speak. We both did.
That's right. Yeah.
Yeah. Well, cool. It is an odd market right now, and
Yeah.
investors are continually trying to be creative. I'm sure you see all kinds of deals come to you at Directed IRA. And for the listeners, Directed IRA is a custodian. If you want to self-direct your IRA, you should certainly call Matt and his team. In fact, I had a meeting with your guys about a month ago. I'm going to get a few going for my kids, some Roth IRAs. So
Heck yeah, yeah. We call them
start
kids
doing.
Roths. Yeah.
Okay,
Kid
kids
Kid
Roths.
Rock, Kids Roth, both
It
exciting things.
it sounds too similar. You can't not say it, right?
That's right.
So, um, a few questions because some of the listeners,
Mhm.
this isn't their first rodeo on this stuff, but for other people, it might be the first time that they're hearing about this. What, how is a self-directed IRA different than like a traditional IRA or even a
Yeah.
401k?
Yeah. Well, most people's IRA or their 401k is with a broker dealer, right? So you're at TD Ameritrade or Fidelity. And so when you're investing that account, you can buy what they sell. It's kind of
Right.
like going into McDonald's. It's like, what can I have here? Well, what's on the menu? What can I buy with my account at Fidelity? Well, what Fidelity sells. And so they're going to let you buy stocks, bonds, mutual funds, ETFs, target date funds. I mean, that's what they sell. That's the business they're in. They're not in the real estate business. They don't want to let you buy a real estate deal. That's a pain in their butt. That's not what they sell. It's not their business. And so when you want to buy real estate or a non-publicly traded asset, you need to use what's called a self-directed IRA custodian. So that's what our company, Directed IRA, does. So when you have an account with us, and it's the same thing, it could be a Roth IRA, traditional IRA, health savings account, like all these accounts, you can invest in whatever assets you want. So real estate's the most popular. So let's say you're like, well, I want to buy a rental property on 123 Green Street, or I want to invest in the XYZ private, commercial real estate fund. You can do that. You're just not going to do it at Fidelity. So you'd open up the self-directed IRA. Directed IRA is the number one company. We're the best. There's 20 other companies that do what we do, just not so well. So you don't need to know who they are. So, but you open up your account at Directed IRA. And then let's say you're like, well, I got 500,000 at Fidelity, but I want to do 200,000 into this real estate deal. Well, it's just a transfer of funds. It's like you went from Schwab to Merrill Lynch. Okay. You're going from, in this case, Fidelity to Directed IRA. We're a custodian of retirement accounts. We're audited, licensed by the banking department, and we'll open up that account. that 200K comes over, and let's say it was a traditional IRA at Fidelity. It's a traditional IRA at Directed IRA. But then you decide how to invest it. So you're like, oh, I want to buy the property at 123 Green Street, or I want to invest in that private fund. We let your IRA invest into those private assets. And so that's what's different than what I would call the brokerage IRA or your conventional IRA, is they typically restrict what you can invest in based on what they sell, versus a self-directed IRA, which is more open architecture. You can invest in any asset allowed by law. Like we've had clients that's IRAs have owned a significant percentage of a professional Mexican soccer team, like a share of a racehorse that was at the Kentucky Derby, startup private companies that went public, tons of real estate deals, of course. And so these are all assets your IRA can own. You just can't do it with the broker dealer IRA. So that's our purpose, is to be that self-directed IRA provider for people to invest in what they know and believe in. Maybe they want greater returns. Maybe they want some diversification from the stock market, but that's what we're out doing every day.
So I was going to ask you like about benefits and risks of using a self-directed IRA for real estate. You clearly highlighted, I think, flexibility being one of the main benefits. What a lot of investors come in the door to you. Why else
Yeah.
are they using self-directed IRAs to invest in real estate? What do you see?
So I think there's kind of three client types that I see. One is, that's probably the biggest bucket, is kind of the frustrated stock market investor. They're like, I've been on the stock market roller coaster. I hear the stock market's up, but my account doesn't seem to be, they're like, the market's been up 8% this year. And they're like,
Yeah.
my account's up 2. What the
Yeah.
hell's going on? And they're in some target date fund they don't understand. And then they try to read it and understand it. And they're like, I don't freaking understand this. I remember I had a pilot who was like, I don't even understand what the hell this mutual fund is. I get the prospectus. I can't even read the thing. He's like,
Yeah.
if I fly a plane, I'm going to know everything about that plane. Here he had like an $800,000 account. I got 800 grand over here and something I don't even understand. Anyways,
Yeah.
so like, but they're kind of like, they want to invest in something they know better and can get a
Right.
better return. And there's risks, of course, in any type of investing. Real estate's a little less risky than someone doing crypto, but you could do both with a self-directed IRA.
Yeah.
So I think they're kind of chasing a better return or maybe some diversification. The second group is they just believe in hard assets. They think the stock market's overvalued. And if you look at stock market valuations and stock, the price to earnings ratios are off the charts. And they're like, I just believe in like a hard asset, whether it's real estate or even a small business that they can know and get their hands around better. It could be secured note lending. They're lending to other investors, getting a deed of trust or mortgage on the property. They feel secure in that. It's like real property and dirt type stuff. It could be precious metals or other things. Just what I'd say, like hard assets, not correlated, or the stock market. The third category is like the more sophisticated investors that are like, I know how to make money in investing, but it's not doing stocks, it's doing real estate or private companies, private equity, and they're using Roth IRAs. So it's like the sophisticated Roth client that just wants to use a Roth IRA to make really awesome investments and do it tax free. So,
Yeah.
and we have, like, my largest client has a Roth IRA worth $400 million. It's like, that's that guy. But we have a lot of them, and there's a few others in the 100 millions and some tens of millions and single digit millions, but they're like Roth account investors that are focused on, they can do this investing personally all day long, but they're like, but my really good deals, I'm using my Roth account so I can keep every penny of the profit.
And I got to backtrack, and I don't want to assume. So the difference between a traditional IRA and a Roth is
When you put money in a traditional IRA, you get a tax deduction. So say you drop $7,000 in it, you get a $7,000 deduction. Same with your traditional 401k. You put 20K in, you get a 20,000 deduction on your tax return. The downside of the traditional is when you pull the money out later, you pay tax on the way out as it's distributing. Now, you don't pay any tax as you're building it and making money, which is awesome. So like the traditional IRA is what we call tax deferred,
Mm.
right? I get to go invest it and make money and build it up, but I don't pay any tax as I'm going. I sell a property or I sell an investment. Every penny goes back into the account and gets reinvested. And when you think of investing for 10, 20, 30 years with a retirement account, that is a massive difference in
Yeah.
how big that account's going to be at the end of the day. The downside being The IRS taxes you on the way out of traditional accounts. The Roth is the opposite. You put the money in, you don't get a tax deduction. The IRS is like, oh, you put 7,000 in your Roth IRA or 20K in your Roth 401k. They're like, good for you. No tax deduction.
Yeah.
But when you invest it, no taxes you're earning and making the money. And when you pull it out at 59 and a half, which is when you can access it tax free, there's no taxes on the way out. So that's like this tax free ATM, as we call it. And we have more Roth accounts than any other account type. We have a lot of people that self-direct traditional accounts, but we have a lot more Roth accounts. And like the national average is like 2 traditionals to every 1 Roth, but we're like the opposite. Just because we attract people that want that tax-free growth and tax-free on the way out.
Didn't Peter Thiel just hit pay dirt on that? Didn't he have like his PayPal shares in a Roth or something?
Yeah, then he was the first outside investor in Facebook. So, Peter Thiel's a famous venture capitalist in Silicon Valley, one of the co-founders of PayPal and the PayPal Mafia with Elon Musk and a bunch of other people. And his Roth IRA is invested in that. There's like 6 co-founders, and he bought some of the early shares. But then his big deal actually after that one was he was the first outside investor in Facebook. And so if you've seen the movie The Social Network, there's a little scene that depicts it where Facebook's getting their first investor, and the guy putting 500K in was Peter Thiel, and it was from his Roth IRA, which, I think he got like 20% for that, 10 or 20%.
Yeah.
And for $500,000. And obviously it's one of the largest companies in the world now. And so that investment itself was worth over $1 billion in returns. Well, that's all tax free in his Roth IRA. So that's like the sophisticated Roth investor where it's like, if I'm going to make this investment, I think it's going to be incredible. I'm going to do it with the Roth IRA. And we see some sophisticated clients do that with their Roths, whether it's a real estate deal, a deal they can option, a deal that they see has a ton of upside, where they're like, I got to figure out how to get my Roth into that deal. And in our law firm, KKO Stories, we're doing some structuring sometimes with clients to see if it works and how to figure it out. But yeah, I mean, that's the cool thing of the Roth is, when all the tax returns from all the wealthy people were released, if you remember that, like 5 years ago, like Warren Buffett's return, President Trump's, like all these wealthy people's returns got disclosed. Well, Peter Thiel was the one that was like, they called him Lord of the Roths. He was the one that kind of like blew everyone away, because it was like, wait a second, how much does this guy have in his Roth IRA? He pays no tax. He's over 59 and a half now. It was like, what the hell? This was so there's some politics to all of that. But anyways, I think it's a good lesson of you can grow your Roth as big as you want. And from a tax planning standpoint, it can come out and be totally tax-free. But what did Peter Thiel do? He used a self-directed Roth IRA. He didn't go buy publicly traded stock, right? He saw the opportunity in an alternative non-publicly traded asset. And so that's what we're doing, whether it's real estate, oil and gas, crypto, startups, small businesses, private funds. I mean, if people see a good investment opportunity, a lot of times they don't think of their IRA or 401k. Their IRA or 401k, they think, oh, I have to invest it in stuff I don't care about or not interested in. I'm buying a mutual fund or whatever, And then, a lot of our clients are like, they're out there looking for all these deals, and they're like, wait a second, especially real estate clients, because they're always out looking for deals and doing real estate deals. And they're like, wait a second, I can use my IRA in this thing. So it's a pretty powerful tool, but it's also powerful for anyone raising capital. Like if you're raising capital on deals, I mean, there's $44 trillion in retirement accounts, 17 trillion in IRAs alone. And if you don't know how those IRAs can invest in your private fund or your deals or be a private money lender on something, I mean, you are leaving the easiest, most plentiful source of capital like on the sidelines. And so it's a really important strategy, even if you don't care about your own IRA, but you care about like funding and raising capital for deals. It's a really, really big strategy to learn.
So I hear about investors going into syndications with IRA money, and that there's this pothole you can hit called UBIT tax. Or what? Could you explain that? And then what are some of the other things to be aware of so that in your effort to avoid taxes legally here, you don't create more problems for yourself?
Yeah. Now I wrote a whole book on this, the self-directed IRA handbook. You know,
Yeah. Yeah.
it's sold 50,000 copies. Government regulators have used my book. The National Association of my industry uses the book. Most of my competitors train their employees on what the hell a self-directed IRA is with my book. So, the reason I say that is if you want a deep dive on this, or your CPA or attorney's asking questions, I got like 100+ citations in this book on how this all works. There's really two things you need to know, though. There's really two rules. One is the prohibited transaction rule, which is, hey, when your IRA is out investing, it's not buying assets from you personally. It's
Yeah.
not buying real estate you're going to go use or personally live in, or your kids, or certain like restricted family members. Your IRA is out investing, trying to make money. So don't try to use your IRA to benefit yourself. Okay. So that's called the prohibited transaction rules. Now, most people aren't thinking about that, but I know there's one person listening that was thinking, ooh, I'm going to buy this second home with my IRA and I'm going to stay in it for the summer. You know, that doesn't work. Okay. It's got to have investment intent. The second rule is the one you brought up, this pothole, some you could call it, something called UBIT. Now, there's kind of two varieties of UBIT, and I don't, you know, if you're listening to this driving down the road, I don't want you to careen off the highway and, you know, and kill and die here, but this is helpful. Okay. Maybe pause it, come back to this, you know, and, you know, I don't want to put you to sleep, but there's two tax things from UBIT. There's UBIT and what I'd call UDFI. You mentioned really UDFI for real estate syndication. UBIT is, see, when your IRA invests, the government's like, hey, when your IRA goes and makes investments and it's getting income back to it, your IRA doesn't pay tax as long as that income is investment income, you know, like capital gain income, interest income, dividend income, royalty income, rental income on real estate. That's all investment income. And when your retirement account gets that, it doesn't pay tax. That's one of the nice things of retirement accounts. Everything builds up. But if your IRA gets business income, this is where UBIT, unrelated business income tax, can apply to your IRA. An example of that would be your IRA did a real estate development, you know, and that's not investment income, that's more business income. Or your IRA flipped like 10 houses a year. Well, the IRS will look at that and say, your IRA is really in the business of flipping houses. If your IRA flipped a few houses a year, that you're fine. But if it did like 10 a year, it's kind of like you personally, you're like a real estate, you have inventory, you're in the real estate business, you're not investing in real estate.
Yeah.
So that's where the UBIT could hit for real estate. The UDFI is totally different. Okay. They're both under the same really tax regime, but it applies totally different. UDFI is a tax that the Congress created and said, hey, if your IRA is investing in something with cash and it uses debt to buy more assets, you have to pay tax on the profits from the debt piece. So for example, let's say you had 100K in your IRA and you bought real estate that was worth $300,000 and you got a loan for the other 200 grand. The IRS is like, you can do that. The loan has to be what's called a non-recourse loan. There's some rules on that. But for the tax, the IRS is like, you know, for the profits from the cash of your IRA, the 100,000, when you make money, let's say you sell the property and you make 100 grand when you sell the property, they're like, okay, 1/3 of those profits were attributable to the IRA's cash. So 33,000 goes back to your IRA. You don't need to pay tax on that because that was your IRA's money. The other 2/3 of profits, that's really because of the 200K of debt you brought in. That was not retirement account money. We'll let the profits go back to your IRA, but you got to pay a tax on them. And this is that UDFI tax. Now, at the time of sale, you would get the capital gains rate, 20%. So in this example, you'd have 2/3 of the profits would be subject to that, 66,000 at 20%. Okay, so that's going to be like 13 grand of tax essentially. Now, some people look at that and say, I don't know, Matt, that sounds like a bad deal. And I'm like, in what world is that a bad deal? Okay. If you had 100K, and most people's 100K is sitting in a mutual fund or an ETF, maybe a stock, you can only buy 100K worth of assets. They don't give you margin accounts and trading on retirement accounts. Okay.
Yeah.
So I can only get return on $100,000. If I can get a 10% return, let's just say in the stock market, being generous here, that 100K can become 110. If I get 10% on a real estate investment and I have a 300,000 property, that 10% is 30K. Oh, but I have to pay tax on 2/3 of that. I'm like, yeah, that was money you didn't even have. You couldn't get a return on. So if I run the math, you always win. Now, you only pay tax when you make money on the debt, right?
Right.
And
Right.
so, and when you sell is usually when we see this, because as you're owning real estate, there's rental income, but you're getting like depreciation, all the expenses, writing it off. So usually we see this tax hit when someone sells. They bought into real estate with debt, or they've invested in a fund, same thing, and the fund has debt. It's the same analysis. Um, so I don't think it's a bad thing. I think if you look at it, what's the overall return you're getting? That's the
Yeah.
analysis you need to make. Because I'll have
Right.
clients too that come to me and say, "Hey, Matt, I've got 600,000 in my account. I could buy, or no, let's say I've got 200,000 in my account. I could buy one property outright with cash, or I could buy three and get debt on them. What should I do?" And I'm like, "Well, are they good properties? Yeah, they're great properties. That's why I'm buying at least one. We'll go buy three. I mean, you get greater return. You're only paying tax if you make more money, and it's only 20%. You get to keep the other 80 on the money you didn't even have that you couldn't even get return on."
Right.
So it's kind of, you have to really think through it. But that is, in essence, UDFI for anyone still listening.
For anyone still listening. Well, and it's not like if you invest outside of the IRA, you're paying that tax anyway. I mean, it's just, yeah. Okay.
Right. On the whole thing. Yeah.
I've got a couple more questions for you before everybody's going to wake up and get back to their day. Um, a lot of people go into real estate because, obviously it's multidimensional and how all the ways that it pays you, one of those being depreciation. As I understand it, that's a little difficult when investing within an IRA. You don't get depreciation, or do you? What is that?
Yeah. So if you think, it depends. Like, let's say you bought real estate with cash and no debt. Well, you don't pay tax at all. So like you can take depreciation. There's just nowhere to put it.
Yeah,
Depreciation only offsets taxable income. Well, the
and
IRA
if you
doesn't
don't
pay
have it,
tax.
yeah.
So I think on it's again, like, do you want to live in a world where there's no taxes, or do you want to live in a world where there's taxes, but you get depreciation to reduce taxes? I'm like, how about just a world with no taxes? Well, that's what your damn IRA is. So
Mm-hmm.
I hear all these other real estate people like, oh, don't use your IRA to buy real estate. You don't get depreciation. You don't pay tax. Who gives a shit about depreciation if you don't pay tax?
Yeah.
The other scenario, though, when you're buying real estate with debt, and I was going through that UDFI example, is depreciation is an expense against what's taxable income for UDFI. So you can use it there to reduce what's taxable income
Okay.
from the debt, because that is this piece where they do make you pay tax, right? If there's gain from the debt piece, but depreciation could be used to reduce that.
Yeah. Yeah. A great way to avoid paying taxes is to not make any money. But if you don't
Yeah.
want to do that, then you've got to grapple with reality.
Yeah. And guys, I'm a tax lawyer. So like I'm,
Yeah.
from my background, and is like I'm only about paying as much tax as you absolutely have to. But I'm more focused on building overall wealth. And I think some people get a little short-sighted, even in my own industry, tax lawyers, CPAs. It's like, that's not very tax efficient. I'm like, but it makes a lot more money than the next option.
Yeah.
Like I'm looking at the net overall return here.
Yeah. Tax efficiency at the expense of profits, right? That's
Yeah.
okay. And then, you own a rental property in your self-directed IRA. How do all those ongoing expenses get
Yeah.
handled? We've got utility bills, or a
Yeah.
tenant trashed my property. I've got a turnover. What does that look like?
Yeah. So IRA buys the property, let's say, just even take my property in Indianapolis, right? So my IRA puts the cash down. I actually did get a non-recourse loan in that example for half the balance. I put down half cash for the 85K. Rental income, I did an LLC. I should probably explain that too. A lot of real estate investors, rather than have their IRA own the real estate directly, they'll have their IRA own an LLC 100%, and the LLC owns the property. It's called an IRA LLC or a checkbook IRA. We set them up in my law firm. I use this structure myself. But the IRA or the IRA LLC is buying the property. It's paying the cash to buy it. Again, you could have a non-recourse loan here helping to acquire it. But the rental income's coming into the IRA or IRA LLC. You're paying the expenses out from the property from the IRA funds. You're not personally covering the expenses. Okay. This is not your property. This is your IRAs.
Yeah.
And, and then when the property sells, the gain goes back into the IRA, or if you have this IRA LLC structure. So, but you're not working on the property either. So that's another thing, is like the IRS is cool with you overseeing and managing the property. You can go to the property, you could show it to a tenant even, you could tell a contractor what to do, but you can't physically put in work on the property. Like you can't remodel the kitchen. Okay.
Yeah.
That would cause a prohibited transaction. So, but the retirement account buys the property, owns it, covers the expenses, gets all the income, and gets all the gain. Just think of it as a separate thing from you. You own the IRA, but it's not on your 1040. You should not be coming out of your personal pocket for anything, nor are you making money personally. It's all building up in your IRA.
Gotcha. Well, that's helpful. I hope some of the listeners see the wisdom in using their self-directed IRA or moving funds to somebody like you, of course. Where can everybody go to learn more if they haven't already self-directed?
Yeah, get over to directedira.com. And if you're self-directing with someone else, you can still get over to directedira.com.
Yeah.
Book a call with our team.
You.
Yeah. I mean, we take all. Book a call with our team. They'll be happy to walk you through. We have an incredible experienced team. You can look us up, check out our reviews. And then we have events too. We have webinars. We have a ton of educational resources. Again, I mentioned the book. If you want to really geek out, we have a podcast, the Directed IRA podcast. We're hundreds of episodes in. We've been doing it for years because there's a little bit of an education hurdle to learn this. And I always tell people, self-directing IRA is more like playing a board game. It's not rocket science, but you do need to learn a little bit, kind of like playing a board game. But once you've played it once, it's the same rule book every time. The next deal is the same thing. The first time it might take a little bit. Okay, can I do that? How do I do that? But once you figure it out, you're just redoing the same thing over and over again. So we're here to help. Thanks for having me on. Hopefully I taught you something new. Anybody? I don't know. Steve knows it all, but maybe someone else learned something.
DirectedIRA.com. Hey, thanks a lot, Matt.
Yeah, my pleasure.
See ya.